Hello, everyone. So let me just start with why we believe financial services as a category is a great way to gain exposure to the Indian growth story. There are three or four broad reasons. The first reason is when you look at the macro, India still is a severely underpenetrated country when it comes to both financial products as well as household financial savings. As economy gains more and more sophistication and per capita income increases, with increasing GDP, we will see a proliferation of both financial products as well as increased exposure of households to financial savings. Therefore, the sector is well poised to grow over medium term as well as long term in both in terms of assets as well as liabilities. The second reason why we believe financial sectors is a good category to be invested in is because if you see for the last few years, there has been several para-banking business models that have got listed in the public markets. Those include things like life insurance, general insurance, asset management, securities companies. They have made financial services as a category way less cyclical than what it used to be. And also, some of these business models structurally can go far longer than pure lending businesses. And the third and impending reason is that if we look globally, several financial fintech companies as well as technology business models which work in financial services industry are getting listed. Globally, the experience is that these business models have created a lot of value for the investors. We expect some of these to get listed in India soon, and the same repetition of value creation that has happened globally, we expect that to happen in India as well. Therefore, these are the reasons why we believe financial sector is a good way to gain exposure to broad Indian economy. So now let's talk about the current outlook of the financial sector. The impact of COVID first and second wave on the sector seems to be lesser than what was anticipated earlier. And more importantly, the asset quality stress that was considered to come out of this situation, the reality seems to be much better than what was anticipated earlier. Also, most of the macroeconomic indicators are indicating that the economy seems to be recovering faster than what was anticipated. And we have seen this happening at the end of first wave also, that the economy rebounded faster than most people anticipation at that point of time. To add to that, most of the large banks today are comfortable in terms of their capital positions. Most of them have raised capital in the last few quarters, and therefore their balance sheets strength is much better than what it was a few quarters back. To add to that, we believe that despite the poor growth in the sector for the last 3-4 years, the sector might be poised for rebound today, and there are several reasons for that. On the demand side, Indian corporates have gone through a long phase of deleveraging. Today, if you look at the publicly listed companies, their balance sheet leverage is almost at 10-year low. And therefore, we believe that the re-leveraging cycle can start at any point of time. It might take another 6-12 months for that to happen, but all the indicators are telling us that Indian corporates can start re-leveraging cycle at any point of time from now. Also, government thirst on infrastructure and manufacturing can give a good impetus to this leveraging cycle. To add to that, property cycle seems to be rebounding in India, and therefore on the retail side, that's a very important indicator for household leverage to go up. Therefore, on all 3 points, from the corporate side, from the government side, and from the retail side, it seems leverage can only go up from here. So this was the demand side of the equation. On the supply side, we believe that most of the banks, as we said earlier, have decent balance sheet strength today, and therefore they are well poised for credit growth. Also, if you look at PSU banks, which form almost 65-70% of the system credit, they have been hampered in the last 4-5 years by their merger issues as well as the corporate NPL issues they face. That also seems to be now at the fag end, and therefore even PSU banks are well placed to participate in any credit growth that happens from here on. So therefore, to sum it all, we are quite confident that the sector is poised for a rebound and credit growth in the impending years can surprise positively. So, given this backdrop, let's discuss the strategy of Nippon India Banking and Financial Services Fund. See, basically, Indian financial sector is divided into five or six subsectors. The largest of them being the banks, as well as the NBFCs. Along with that, you have the insurance companies, asset management companies, securities broking, and some of the niche fintech models that are emerging today. The fund first try to identify which are the subsectors that are looking attractive in terms of risk reward over the next few years. And within those subsectors, which are the business models that we want to bet on and where we like the competitive moat and the strategy. So it is a mix of both macro and micro when it comes to managing and the investment strategy of the fund. To add to that, if there are certain business models where we are confident and where we have high conviction, we take bets on such business models to generate alpha. So after the flavor of the strategy, let's now discuss the current positioning of the fund. We have taken large exposures in the large banks, large private sector banks, as well as some of the large PSU banks today, because we believe banking industry is going through a phase of consolidation in which the large banks, especially the private sector banks, are gaining continuous market share. We believe this phase will continue for a long time to come, and therefore the fund has taken exposure to some of these banks. Another important reason why we like large banks is emergence of these para-banking subsidiaries under the large banks. Today, most of large private sector banks are leaders in or have subsidiaries which are leaders in things like general insurance, life insurance, asset management, etc., etc. What these subsidiaries do is, one, they provide much more structural nature to the business model. They are not as cyclical as the pure lending business models of banks. That is one. And second, the value of these subsidiaries in the overall market value of the listed company is increasing every year. And therefore, it provides stability as well as less cyclicality to the business models. That's why we like some of these large banks. With broad-based recovery expected in economy once the COVID phase is over, there is a good possibility that even some of the laggards, some of the mid-sized PSU banks, and some of the mid-sized private sector banks do well. Selectively, we are positioned in some of those as well. To add to that, we have exposures to niche business models in specialized insurance companies or in specialized asset management companies where we find the risk reward attractive. Overall, in a nutshell, we believe that this sector has ample scope of re-rating once the COVID phase is over and once credit growth in the system comes back. And Nippon India Banking and Financial Services Fund is well positioned to take advantage of that re-rating and the credit growth whenever that happens. So given the strategy and the positioning of the fund, you could consider investing in Nippon India Banking and Financial Services Fund. It is our constant endeavor to create long-term wealth for our investors. Having said that, thank you for this. Thank you for listening to me.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.